Hey everybody, Jeff Gibby here over at MetaStock. I hope you're doing well. Thanks for coming. Uh, let's go ahead and get started. I'm going to jump over to this really interesting legal disclaimer. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. So, there you go. Today we do have a special guest, Barry Burns. Barry is been working with MetaStock for a number of years, and he's a great technician. I particularly like his modified Elliott wave count and the simplicity in which he takes everything to court, as he says. So we're going to go ahead and bring him online and have him talk to us a little bit. So let's do that. Hey, Barry, how are you?
Hey, Jeff. I'm doing very well and getting better by the minute.
Great, great. Well, I can hear you. You sound good. And I just sent the screen share controls over to you.
All right, so there we go. I brought up my screen. Can you see it?
I can. Just need to modify it just a little bit for the YouTube view. Okay.
Okay.
You look perfect, or your screen looks perfect, I should say.
Oh, that's what all the girls tell me. I look perfect, but I don't know if I really trust them or if they're just after my money.
I'm a horrible judge.
Okay, well, thank you for the compliment, but I guess you're really complimenting my screen. But I'll take anything I can get. I'll twist it to my own advantage.
All right. Very cool. So I'm going to get out of the way.
Okay, my friend. Well, thank you so much for inviting me on. It's been a great partnership with MetaStock and Top Dog Trading. I've really enjoyed it. In fact, back in the days of yore, no, I go back a long way. Back in the days of pre-yore, that's how old I am. MetaStock was the very first charting software ever used in my entire life. When I started trading, I was 8 years old. Actually, my dad, he was a stock trader, so I was kind of raised in it, and it was my dad's passion. So he talked about it all the time, much to my mother's dismay. And so I just kind of became immersed in the markets. He began my formal education when I was 8 years old at our dining room table in our little brick house in Detroit, Michigan. So at 8, of course, I didn't really understand most of what he was talking about, but just kind of threw me in the deep end of the pool. And every week we'd get together at the dining room table and he'd bring out some stocks, show me 5 stocks, said, Bear, which one should we buy? I didn't really even understand what a stock was at 8 years old, but I'd ask questions, he'd explain, and over the years, I started to catch on. Now, of course, that was before MetaStock was around. It was before uh, computers were around. We didn't have software. We didn't even have hardware. Heck, we had a TV and it was black and white. So that's that's how old that goes back. But when we did get a computer and we did get charting software, MetaStock was the very first one. And here I am all these years later. I'm 60 years old now and still using it. So just a real testament to how well you guys have done, not only in creating great software, but continuing to evolve it and adapt it as markets have changed, which they have a lot over the last 50 years. So anyway, today's topic is going to be about timing strategies for entries and exits. So, it'd help if I would actually activate my slide. And there we go. So you did a nice little preview there, but I'll just do another little quick one here. I'm the author of Trend Trading for Dummies, published by Wiley & Sons, obviously, the famous Dummy series of books. I've received numerous Reader's Choice Awards from Stocks and Commodities magazine, and I've contributed to other authors' books, worked for some other major companies out there doing seminars like this for them, and exchanges, etc. So if you want to see my full bio, feel free to go to topdogtrading.com, click on the About Me tab, and I'll be very, very happy to, let you see my full bio there, which is a lot longer than what I just showed you, but I don't want to spend our time talking about me. We're here to talk about you and your needs and help you in your trading. So I took a survey a while back and see if you can resonate with this. I surveyed over 10,000 traders. And I asked them a bunch of questions, but here was one of them that I found the most interesting. I asked them, what are your most common trading problems, struggles, and frustrations? And if you want to take those in, feel free. That would be very interesting for everybody to see. And I think it'd be helpful for you as well to see that you're probably not alone in your trading challenges. You know, trading can be kind of isolating. We sit in front of our screens and we're fixated on the movement of every penny, pip, or tick. At least some people are. And, you know, it's not that social normally unless you're part of a trading group or club, which would be great and I highly encourage. But sometimes we don't realize that other people are having the same problems as we are. And so we start to think that we are exceptional in the area of having unique problems. So I'm going to share with you the top answers that came in and see if you can resonate with these. So, and by the way, I've kind of grouped these together and created little groups of these because the wording from each individual response was obviously a little different. So one of the biggest ones that came up was people saying something to the effect of, I get into the market, let's say buy, could be buy or sell. And as soon as I get in, I execute my position. And it seems like as soon as I get in, well, god darn it, the market turns right around and stops me out. It's almost like somebody's just waiting for me to get into the market, watching my position. I even had some people say they think their broker is watching their little account and trading against them. Or the market makers are watching their stops and taking out their stops. Because it just seems uncanny how often, how consistent it is. There's a real long-term pattern where they get in, they immediately get stepped out. But then to add to the frustration, the market then goes against the stop and goes back in the original direction of their trade. And people say, man, this happens so often that I'm just always wrong. And that's what that is, the timing. That's what we're talking about today, timing. You were right. In fact, one of my mentors at the Chicago Mercantile Exchange, he said, Barry, retailers are often right, but at the wrong time. And that's exactly what this talks about. The big direction, you got it right, but got in maybe a little too early. Another one is kind of the opposite. Okay, you got in and maybe the market moved, but then you get out too soon. So you made some money, got some green, seeing your P&L go up, but then you get out for whatever reason, various reasons. And then you see as soon as you get out, well, the market keeps going in your direction. And that gets frustrating because it's like, man, I could have made all this other money that I left on the table. How do I do that? So that's, again, a timing issue. When to get out. So when to get in, when to get out. Another one is getting stopped out too often. Another one, not knowing the best place to exit the market. Another one is trading a trend that doesn't follow through. So here's a little different issue where, okay, you see what looks like a trend starting up, you get in, but that trend fails. And it doesn't actually follow through. Maybe the market just goes into a choppy direction or the trend actually turns around. So these are the 5 top issues that people reported. So if you have any of these issues, don't feel bad. You are not alone. You are not a uniquely bad trader. There's nothing wrong with you. In fact, these are common experiences we all have had, including myself. And the good news is there's an answer to each one of these. There is hope. There is hope. There is light on the other side of these problems. So the way that I have solved these problems is by creating not just one thing. I want to be very clear about that. There is no one holy grail indicator or price pattern or moving average or anything. Successful trading is about having a methodology, a system, and it's basically a mathematical system that puts the odds on your side. So the way I do it personally, and by the way, I'm not saying mine's the only way. In fact, I will tell you upfront, it is not the only way. I know lots of traders who make money doing lots of different styles and systems and methodologies. There's many ways to, well, groom a cat. I've got a cat, so I got to be careful how I word that for my cat. But this is the one that I've settled on. This is the one that I personally use. So it's all about measuring what I call the energies in the market. So what do I mean about energies? I mean the energy of money flow. So the energy of money is money flow. And to me, this is what the markets are all about. It's called market auction theory, where the markets are a big auction place and you got people bidding and asking. And when people are very interested in something, let's say it's a piece of art, then they will bid it higher and higher and higher and higher in price. And what is that? Well, it's basic economic model of supply and demand. And this is true of any market, whether it's the art market or it's classical cars or it's stocks or forex or futures or options or commodities or whatever. And that's what makes the markets go around. That's what makes the prices go up and down, supply, demand, how much interest is there. Sometimes, by the way, that interest is based on very logical things, such as the fundamentals of a stock and of a company. Other times, it's not based on logical things. If you ever wondered, God darn, the market just doesn't seem to make any sense. Sometimes it doesn't, because people get, well, what Alan Greenspan would call irrational exuberance. Back in the tech bubble, if you remember, the market, these tech stocks especially, went up and up and up and up, and they had horrible fundamentals. They didn't have any profits, but they kept going up year after year after year. Why? Because people were excited about them. So people don't always base their decisions on logic or on reason. Sometimes they just get excited about something, and the price will still go up because supply is still dominating demand. Or demand is dominating supply. Sorry, got that backwards there. Flip that ratio over. Demand, people want it, want it, want it, want it, want it. Bitcoin, we saw it happen with that. Housing market, we saw it happen with that. Tulips, well, I wasn't around back then, but we all know the history of that. So when people want something, it goes up. So we look at 5 energies and we look at 5 uncorrelated energies of money flow. So what we're looking at here is just the raw action of the market participants as determined by follow the money. Where is the money? It's not about theory. We're not doing any kind of theory here. We're literally following the money. All right, and the big money, the dominant money. And when there is no imbalance of supply demand, we don't trade. We keep our powder dry, or we go look to another market where there is a raging bull market or raging bear market. So here are the 5 energies that I use. Number 1 is trend. And we start with these. These are in this order. So my methodology is literally a 5-step checklist in this order. Number 1, trend. Why is that number 1? Because, well, it's dominant. If the market's moving up and you decide to go short for whatever reason, I don't care what it is, you will lose money. You will lose money. Trend is a binary distinction. The second one is momentum. Now, early in my career, I was a trend trader. I still do trend trading, but there's one point in my trend trading career when I was, making some, losing some, making some, losing some. My equity curve wasn't going up as much as I would like. And I felt like I was not seeing something. I felt like I was blind to something in the market. I get all these beautiful trend setups, and then some would follow through and some wouldn't. And that was one of the problems that people mentioned, buying a trend that didn't follow through. Well, I had that problem too. So I hired a mentor, and the gentleman, just to really bottom line it for you, showed him some of my charts, some of the winning trades, some of the losing trades, and he said, okay, well, let's take this example right here, Barry. Let me ask you one question. Is that a strong trend or a weak trend? And my answer was something to the effect of, it's I don't know. And I didn't. I was clueless, so I wasn't going to try to fake it. So that became the distinction that I learned from that mentor. By the way, in trading, the dollars are in the details. These little distinctions. You can get all the, the big stuff. What is a trend? What is this? What is that? All that stuff's for free on the internet, right? And if it all worked, well, then everybody may be making money. And as we know, most people lose money. So if you get your education from the same place most people do, you'll get what most people get, which is losses. So the real key is in these little details. So for example, with momentum, that determines the strength of a trend. Trend is not enough. It has to be a strong trend. All right, so in fact, he had me take a little Post-it note, I remember this, and write that question on the Post-it note. Is this a strong trend or a weak trend? And then I put that on my monitors, and he said, ask yourself that question now every time before you take a trade. And man, I got to tell you, there's very few things that turn my trading around overnight. That was like one of two things in my whole life that dramatically, no, there was three things that dramatically changed my trading overnight. And that was one of them. So my win-loss ratio then dramatically changed because I only traded strong trends. Now, when we got a trend that is up and it's strong, then we have a raging bull market. Now we got a strong raging bull market. So now the question becomes, okay, we've got a great situation here, a great meta pattern for a trade. Now the question becomes a little more micro. We got the macro there with a strong trend. Now it comes down to when exactly to get in. This is the problem that people said where they get in, then they get stepped out, and then the market continues in the direction of their trend. See, they don't have a tool to time their entries. And it's very interesting. Very few people do. This, by the way, was another thing that turned my trading around, because the trend is a big long-term move. But within that trend, we get highs and lows, highs and lows, highs and lows. And knowing when to get in is so key. In fact, if you think about it, just from a logical perspective, a chart is a two-dimensional object. That's all we got. We've got price on the right axis and time on the bottom axis. 2 dimensions. And yet very few people ever talk about timing. Very few traders have a timing tool on their charts. Everybody in their parakeet talks about price action, support resistance levels. Those are all part of the price axis. And that's great. You got to have that. But that's only 50% of the two-dimensional object we call a chart. If you think about it, how can you have a statistical probability when you're only using 1/2 of the chart? You can't. So timing, having a timing tool is absolutely critical, and that's where cycles come in, timing highs and lows. We'll show you that in a minute. Support resistance, very important. All traders use this that I know of that at least are making money. These are areas where supply demand has come in the past. We look for them to either hold or break into the future. Those first 4 are used on one time frame. Then, as our 5th step in the 5 energy method, we go to the next higher time frame. And there, we look to trade in the direction of momentum of the higher time frame. So this is a filter. When you put together a trading system, we have conditions, we have filters. This is a filter. We've got a setup on our shorter term time frame based on the first 4 energies, and it's looking great. All of those are bullish, let's say, or you could do conversely bearish. So all 4 of those energies are aligned to being bullish. And then we have to, before we take the trade, run it through our filter. And that filter is not trend. A lot of people tell you to trade in the direction of trend of the longer term time frame. Problem with that is trend is a lagging indicator. So why would you put a lagging indicator in an already slower time interval to confirm your trade on the shorter term chart? That'll make you doubly late to the party. And one of the distinctions, again, between professional and amateur traders is professionals are always in early before the amateurs. Amateurs are always waiting for too much confirmation. And I get it, because most of the time in most things in life, the more confirmation you wait for, the higher probability or statistical scenario you have of being right. And this is part of why trading is so challenging, because in trading, that thing that serves us so well in other areas of life does not serve us well in trading. Because by the time everything aligns, looks beautiful, you're too late to the party. So I'm sure you've heard of the old slogan, buy the rumor, sell the news. Buy the rumor, sell the news. Professional traders buy the rumor, amateurs, they buy the news. Now that not only applies to literal news like earnings and so forth, but it applies to technical analysis as well. The news, so to say, in technical analysis is when everybody can see it and it's obvious to everybody. Remember, most people are losing money. So when most people see it and take the trade, well, it's not going to work out. So trading is very counterintuitive. It's counterintuitive to us as human beings because we are by nature social beings and we have a herd instinct. So one of the biggest psychological challenges as a trader is to overcome that herd instinct in the arena of trading. So we have to learn to get in when it feels a little uncomfortable, but we actually have the statistical odds on our side. Because after all, that's what we're doing, is we're trading probability scenarios, right? We never know. Nobody knows, and I certainly don't pretend to know what the market's going to do in the future. Sometimes people ask me, well, how do you predict the market? I don't. Nobody does. Best traders in the world don't. I don't like using the term prediction when it comes to trading, just because nobody knows. There's no saying that the market could do anything at any time. And that is 100% true. 50 years, I've seen the market do all kinds of crazy stuff that sometimes made no sense. But again, a lot of times people make decisions based on emotion. Another thing is that, certain people can make certain tweets these days, and that'll make the market move. Whether it's really significant or not, it still makes the market move. And by the way, a lot of times these things come out when it's not on an economic calendar. It just comes out of the blue. Bam, there it is. So how do you account for all of that? Well, you've got to learn, and by the way, you've got to be a professional risk management person and a professional money manager. That is way more important than learning price bars, indicators, moving averages. Those things are all great too. I'm not saying it's an either or, but I'm saying in priority. In fact, let me ask it to you this way. Have you spent more time, and you don't have to answer if you don't want to, but just answer to yourself. Have you spent more of your time in your trading education testing out different indicators and trying them out, moving averages and bars and all that kind of stuff? Or have you spent more time in your education on learning the mathematics and statistical probabilities as it relates to money management and risk management? If it's the former, that's why you're losing money. Every single professional trader I know, we focus on risk management and money management primarily because of the unpredictable nature of the market. You must be obsessed with money management and risk management. Now, I know that's not the big shiny object, and it's not. But the big shiny objects are rarely the truth. They're rarely what really works. They're usually just built around marketing to get your attention because everybody wants the brand new thing. Well, there's really nothing new under the sun. So, not even saying those things are bad necessarily, but they're not the key. So the way we put together a probability scenario in trading is we look at our entry point. So this is right at the moment we're considering entering the market. We look at those 5 energies of money flow. Now remember, it's not really about the indicators. The indicators are just math equations. In fact, literally, I'm a very literal guy. So if you look at those lines and all that stuff on your chart that you call indicators, those are not the indicators. The indicators are math equations. Told you I'm very literal. That's what they really are. They're literally math equations. And then they plot or draw those lines on the chart. So what they're really doing, the indicators are taking data from whatever market you put on the chart relative to whatever time interval you set it to, and then it's plotting that math formula visually. So what's behind the indicators is the energy of money flow calculated through a mathematical formula. So when you look at it that way, and we're using 5 uncorrelated instruments, these are instruments like you'd see in the cockpit of a plane: altitude, the speed, the tilt of the wings, the tilt of the nose to the tail, and which that's how we fly a plane. Well, this is how we fly a trade. We look at these various mathematical instruments, which are very objective, and we see how the market is flying through the economic atmosphere, if you will. And when we get all these 5 aligned, we're good. We're flying nice. When they're out of kilter, we could crash, so we don't get in the plane. So we look at those 5 energies and we ask, okay, how many of them are all bullish or bearish at the same time? And literally just give it a score of 1 to 5. So that's how we trade. The higher the score, the higher the probability of success. It's kind of like taking each trade to court. And Jeff, he mentioned this in passing, and this, I really do like this analogy. What we need are 5 independent witnesses to establish a preponderance of the evidence. So the operative word here is independent. So I see so many people who they really don't understand the intelligence or rationale behind even the indicators, if they're using indicators that they're trading. So they might put 5 indicators on a chart, let's say, just as an example, but they don't realize all 5 of those indicators are really measuring trend. Or they might put a momentum indicator on there that really is, it's called a momentum indicator in the books, but it's not truly mathematically measuring momentum. But they don't know that. So what they're getting is not 5 uncorrelated energies. If they have 5 trend indicators on there, they're measuring one energy with 5 different instruments. That's like putting 5 speedometers on the dashboard of your car. See, when you have the knowledge, you would never do that. But if you don't know the depth of how these things work, then you do it innocently and wonder why you're losing money. So it's just like in court. If someone is accused of doing something, they put him, well, he goes to court, and then they have 5 people testify. And let's say those 5 people are his, I don't know, girlfriend, his best friend, his brother, his daughter, and his girlfriend, or his mommy. Okay. And they all say, oh, yeah, he didn't do it. He didn't do it. That does not carry very much weight in court. Not as much as if they had 5 witnesses who didn't know him prior to the event and don't know each other. Now, those are 5 uncorrelated pieces of evidence, or 5 independent witnesses, and they all said, yeah, we saw him with our own eyes. Okay, that guy's going away for a long, long time. And that's what we want with our trades. We want them to go for a long, long time and to have a high probability. So here's how it looks on a chart. All right, so we've given you the concepts. Now, let's say, okay, well, but what's that really look like, Barry? So here's what it looks like. So we've got our 50-period simple moving average, 5 energies aligning at the same time, starting. Number 1, we're starting a new trend. And as Jeff mentioned, I have my own proprietary way of measuring waves. This is not Elliott wave per se. The way that I measure waves is very objective, meaning that we do not recount waves, sometimes with Elliott wave. The thing with Elliott wave is, and I got nothing against it really, I have a friend who makes a lot of money with Elliott wave, so that's awesome. Like I say, there's more than one way to groom a cat. But for me, I just found it didn't fit my style because I need a very objective approach to trading. So I've traded with my friend, and it would always drive me crazy when he'd recount the waves. And they got to recount the waves because they have a principle they're imposing on the market, which is that every trend has 5 waves. So when it doesn't meet their wave count and it goes beyond 5 waves, well, then they got to recount the waves, got to move them around. That just kind of drives me crazy. So with mine, we can get more than 5 waves. But we've measured it statistically, and it just so happens that it turns out the average trend is 5 waves, but we allow it to go for more. It could go for 7 or 9 or 11, or it could stop at 3. But that's why the average is 5, and there's no, wave recounting or having to recalculate all that stuff. So the earliest you can get into a new trend is at wave 2. So 1, 2, we've got an uptrend here. And this is key. So you've heard the slogan, the trend is your friend until the end. What that really means, the learning moment from that slogan is to get in early in a new trend. That's what you should really take away from that slogan. The mathematical model is that the longer a trend continues, the less likely it is to continue. So to start putting the odds on our side statistically, we want to get in early in a new trend. And the earliest you can get in is after 1, 2, first retrace in a new trend. All right, so that's energy number 1, check. Number 2, this is the momentum indicator that I use. All right, it's angling up, therefore strong trend. Okay, check off number 2. 3, now we've got a raging bull market. We're early in that raging bull market. So when do we want to get in exactly? So we've got our cycle indicator here. It's a modified stochastic, as you can see. But the key is the pattern on it. Just like there are great price patterns to trade, we look for indicator patterns. So on this modified stochastic, we've got a little mini divergence there. See, the black line is K. Look how K and D, the blue line, are both going up, while price is still making lower lows. That is a little momentum shift pattern, because stochastic is a little momentum shift indicator. So that says, oh, down here, we're having a little momentum shift inside those bars. Notice they're just, bars that are engulfing each other, and then finally, boom. So that little pattern right there determines when we're going to get our final cycle low. Okay, we've got support at the 50 MA, by the way. Here's another little piece of professional advice. A lot of people think support resistance levels are lines. And that's a natural assumption because we draw them as lines on our charts. But in real life, they're not lines. When I say real life, I mean the way the market really works is an auction place. So you have, what do we got here? We got a 10-minute chart. So you're going to have some people using a 15-minute chart, some people using a 5-minute chart, some people using a 60-minute chart, a daily chart, whatever. So you can't really think of these as lines. They're more zones because different people in different time frames are seeing their lines in little different places there. And the market is also not that persnickety. It's not that exacting. I mean, think of it. You got people all over the world, all different countries, maybe trading various derivations of the market, different exchanges, different time frames, certainly. Getting in a little earlier, a little later, a little slower feed, a little faster feed. So it's going to be around this zone. All right, so don't think of it as an exact line. That will not serve you well. Don't try to look for, well, the line's at this pixel on my screen, so that's support. No, this is in that area. All right, so then we look to the next higher time frame, and we have momentum going up. So I like to use a 1-to-3 ratio. That's 10-minute, that's 30-minute. And momentum is going up there too. We got a cycle low over here too as well, by the way. We got the support of the 50 MA is here as well, by the way. So that's a 5 out of 5 trade. That's a beauty. Take that all day long. Absolutely. Okay, so that's one example. That's how we put it all together. That's just an example of it. Now, let me show you, let me deep dive a little deeper here into some more details because the dollars are in the details. So let's talk about this cycle indicator or this modified stochastic that I showed you. Let me really deep dive into that. So we pull up on MetaTrader, on MetaStock, I'm sorry, pull up on MetaStock the stochastic oscillator properties. By the way, I don't use MetaTrader. I don't know why I said that. So MetaStock has much more flexibility on how to do this stuff. And we need that flexibility. So you don't want to be with a charting platform that limits you too much. We're trading for things that are very important for us here. We're trading not just for money. We're trading for our retirement. We're trading for our time freedom. We are trading for our charities, our children to go to school. So, sometimes I tell people, well, you should use MetaStock because it has all of these great features and functions and variables and the scanning program, which is amazing. And they say, yeah, but I use this other program, whatever it is. I'll say, so you think that a professional trader is going to let that stop them? No, they're going to go use the professional trading platform because they want to make money. They're not going to just say, well, I use this charting platform, so I got to stay with that charting platform. No, you don't. You want to go with the one that's going to make you money. You got to bottom line this puppy. These things are too important. Your kid's college education is important enough for you to make the change. Absolutely. Your retirement. Oh my gosh. So yeah, don't be shy about that. Now, here's what we do. We pull up the stochastic oscillator and we're going to change the parameters. So the parameters that we're going to change are in %K. We change it to, well, you can see the settings there. I'm just bringing over my little spotlight. Time periods, 5. Slowing, 2. Then %D, we're going to change that to 3. Method is simple, and you can use whatever style or color that you want. That's just personal preference. Okay, so that's the modification. Remember, I call this a modified stochastic indicator. So those are the modifications. This will turn it into a timing indicator or a cycle indicator. Now, we're also going to put some horizontal lines on there. So we're going to put them at 20, 50, and 80. 20, 50, and 80. Again, whatever color or style you want, that's personal preference. So those are the indicator settings or inputs. Now, again, I got to really emphasize this. By itself, it's meaningless. Any indicator is meaningless by itself. The number 1 does not give you a probability scenario, but it is one piece of evidence, one piece of uncorrelated evidence. So that's why we use it, all right? But it's not a one-to-one correlation between using this modified indicator and making money. So we got to put it all together, right? Trade cycles in the direction of the trend early in the trend. Also, only trade cycles that have the long-term momentum behind them. Also, only trade when the fractal energy, that's what I call the longer-term time frame, when momentum in the longer-term time frame is aligned. So gotta have, and then also the little mini divergence there that I showed you, I call that the second chance pattern. Gotta have that as well. That's what tells you there's a little momentum shift between the strong hands and the weak hands in the market at that low or at that high. That's what that mathematically measures. So these little second chance patterns, as I said, they indicate a momentum shift. We can call it a mini divergence. There's 5 other patterns that create these little second chance patterns as well, but today we're just going to look at the mini divergence. So why is this important? The reason these patterns must be there is because what we want to avoid is this, and this was one of the problems that people talked about in the quiz or in the survey. So here's what we want to avoid: market coming up, hitting resistance of the 15 EMA in this case, coming down, not making a lower low, and then going back up and stopping us out if our stop's up here. Comes back up here. Okay, then we get stopped out. And then the trend goes back down. So this is an example of, I was right, but at the wrong time. That was not the right time. So how do we solve that problem? Well, actually, we do it with these little mini divergence patterns, or these little second chance patterns, or these little momentum shift patterns, whatever you want to call them. So here's what it looks like. So here we've got to retrace in the trend again, 50 EMA going up. That's why I measure trend. Okay, come back to the 15 EMA. That's what this black line is, the 15 exponential moving average. Got just a little bit of a lower low on price, but look at K, higher low on K. So in K, literally, well, George Lane, who created the indicator, created it as a momentum indicator. Now we reduced the value of K down to 5. And the reason we did that is because we want to measure momentum shifts just within like 5 or 6 bars there, really 5. Okay, 1, 2, 3, 4, 5. And that's what we're doing. We're identifying a little momentum shift within 5 bars where the momentum that was down now shifts to up. And remember, momentum is strength. So then after those 5 bars, boom, time to have the trend resume. So this is our little scalpel, if you will, for entering trends. All right, by the way, it not only works for trend trading, works for reversals as well. So after we get extended in a trend, by the way, just to be real clear, I wouldn't use this against a trend unless we're already extended in that trend. In other words, when the trend is no longer our friend. So we've been going down in a long trend down, long trend is no longer our friend. So now we wait. How do we know when to take that reversal? Again, the question of when, timing access, lower low on price, higher low on K. Momentum shift within those little 5 or 6 bars there, boom, and up she goes. Now that's a big winner. Did you know that trend reversal trades have a better, in fact, they have the best risk reward ratio of any trade in the world? Better than trends, because we're getting in before a new trend starts. It can also work for contractions, for breakouts. So a lot of people always ask, well, how do we know when the market's going to break out when it's in a sideways movement? Well, here's one way. Price just been kind of going sideways. 50 MA basically just kind of flatlining here. Price goes up. K goes down, the blue line. Lower high on K, again, just within a little 5-bar pattern there. But there's the changing of the hands from the weak hands to the strong hands, and away she goes. All right, so that's for sideways markets. So this applies to, again, now this, we've got several things going on here. We've got a big pattern or meta pattern. This could be a trend trade, a trend reversal trade, could be a head and shoulders, double top, triangle, whatever. So those are your big price patterns. But then the question is, all right, I've got a great price pattern setting up here, but when exactly do I get in? So that's the micro, that's our scalpel, that's our little momentum shift patterns here on the modified stochastic. So we're waiting for the alignment of the 5 energies to put the odds on your side. Can really summarize my whole trading method in one sentence. That's how complicated it is. So I might want to write that down. We're looking for trend. And again, the little distinction there, early in a new trend. I like the first retrace in a trend. Then it has to be a strong. That's long-term momentum. Now we use a long-term momentum for that. And because trend is long-term, we've got to use a longer-term momentum to make sure it's strong. Then once we got that, we've got a raging bull market, raging bear market. We want to get in. Now when? If we get in too early, we get stopped out. If we get in too late, we're tracing the market. So we use our little modified stochastic indicator. Then we want that lower that high to come in at support or resistance. Once we've got all 4 of those, awesome. 4 uncorrelated energies, all aligned bullish or bearish. And then we do one last thing. We filter it through the longer term time frame. And again, I do not look at trend of the longer term time frame. That's a lagging indicator in an already slower chart. So instead, I look at momentum. We've seen how momentum can lead price. That makes those 2 time frames, the shorter time frame and the longer term time frame, correlate better, gives a tighter correlation between the signals. And very few people do that. Most people use trend. And so they're late, we're early. And that's where the professionals are, and we want to join them. By the way, because it's all based on market auction theory, supply demand, this will work on any market with this caveat. I will give one caveat here. And I trade the same energy or 5 energy method on stocks, commodities, options, currencies, and futures. But the caveat is only markets with professional participation. Because remember what we're looking for. We're looking for the big guns to come in, the institutions, the hedge funds, the pension plans, the big money, in other words, the banks, because we're not going to beat them. Okay, these guys are really smart. That's why they call them the smart money. They got power. They got big accounts. And they have some advantages that we don't have. A lot of people complain about that. Well, yeah, they do have some advantages. So instead of complaining about it, well, if you can't beat them, join them. So therefore, sure, stocks, commodities, options, currencies, futures, they all work on the same basis of the market action. But if there's not professional involvement, then I don't want to play the game there. I'm not going to play around with people who, because what happens is the chart patterns actually reflect the psychology of the traders participating in that market. So on markets that don't have any professionals trading, you're going to see a lot of randomness and choppiness and trends not following through, and higher highs taken out, lower lows being taken out right after that, because the people trading it are just chaotic. They don't know what they're doing. They don't really trade by a plan, or they trade too emotionally. And that's reflected in the chart. As opposed to charts that have professional participation, well, that's where your nice sine wave patterns come in, your nice stair-step trends, because they're coming in with accumulation, they're trading with an algo or mathematical formula. So it's a very nice tradable pattern. And it's a logical, reasonable one. So, and hey, if you can't beat them, join them, like I said. So we might as well follow them. Hook your wagon to the whales. Okay. And by the way, sure, I've shown you different examples here with different time frames, if you haven't noticed, but investing, swing trading, day trading, I do all 3. With day trading and swing trading, I trade almost purely fundamentals. Purely technicals. When it comes to swing trading, I will note when is there going to be earnings reports or dividends, things like that. In investing, I go a little bit more into fundamental analysis as well. Day trading, obviously, we're looking for economic reports as well. But other than that, it's mostly just technical analysis. So it's simple. I'm sure all of us here can count to 5, and that's pretty much what we're doing. So the MetaStock has some really special things that no other software does. And they have been kind enough to work with me and to create some things here that are not available anywhere with any other software for top dog trading. So what they do, these guys are geniuses here who have programmed this, because I certainly couldn't do it. So they add the wave counts. So we talked about the top dog trading wave counts. Those are very objectively measured, and they are automatically plotted on your chart. So no guesswork. Okay, trend up and down, measured here, green and red. The modified stochastic indicator already done for you. And then here's the real cool thing nobody has, this commentary. Oh my gosh. So what we did here was, this is measuring this point right here. So wave 9 reversal short. And then it tells you, okay, wave 9, here's this basic setup. Okay, that's the criteria technically. Then commentary, setup, tells you what it is. Confirmation, that's where you look at the longer term time frame, tells you what your entry is, where your initial stop goes, and where your exit should be. I mean, my gosh, again, wow, that's just incredible. Nobody else has that except MetaStock. It's just, I don't even know how they do that. They're wizards over there. So I think Jeff's going to talk more about that, but I just wanted to show you that myself because I'm so proud of them and I just love using it, and it's just the best. So in addition to that, Jeff's going to talk to you about that. If you want some extra freebies from me, I got some freebies for you here today. So there's my email address, by the way. You can always email me at barry@topdogtrading.com for any questions you might have from this presentation or anything that comes up in the future. I love talking with traders, so don't be shy about contacting me. You will not be bothering me. No trader ever bothers me. And I'm going to give you the freebie of my rubber band trade today. This is an actual trade setup rather than just sending you a ebook with some general info that's nice to know. No, let's make this practical. I want to help be making you some money here. So this rubber band trade strategy is a great one that I still take every single day it sets up. So it's a little video course, a little five video course. And what you do is, well, you just get everything. You get the complete rules on where to enter, where to exit. You're going to get, in this course, I call How the Pros Trade Different Than the Amateurs. Referred to that a little bit today. I'll go more in depth in that. And then also, I'll give you my cycle indicator for precision entries and exits in a follow-up webinar. And you get it all by just going to topdogtrading.com/free. So that's my little extra contribution today for everybody. Jeff, let me turn it on over to you, my friend, and you can talk more about the top dog trading integration with MetaStock.
Okay. Before we let you go, there's a couple comments and one question that came in through the chat room. Barton says, "I'm a big support and resistance traders. I trade DTE SPX options. Can your system help me?" ?
Yeah, absolutely. Yeah, you should. Everybody should be trading with support resistance. So that's energy number 4 in my 5 energy methodology. The question with support resistance is those are decision levels. So as we all know, sometimes the market bounces off. Let's just take resistance. Market's going up. Sometimes it bounces off resistance. It goes back down. Other times it slices through resistance and goes to the next resistance level. So the key question is, those are always decision levels, but is it going to bounce off or break through this time, meaning the time you're watching the market? And the answer is, that is determined, or it is identified with momentum shifts. So if the market's going to break through resistance, it's going to go with, it's going to break through with strength. Now, to break that down even further, momentum is velocity times mass in physics. I'm no physics expert. I've only taken one class in physics. So if I can figure this out, I'm sure you guys can too. But in trading, what that means is velocity is the speed of the orders going through the market. How fast and furious are those orders going through? And then momentum equates to volume, or sorry, the mass part of momentum equates to the volume. This is where we want to have the big guns in there with us, the whales. So if the market's moving into resistance with lots of orders coming through fast and furious, and big volume, specifically block trades, institutional trades, okay, that's what causes it to go through resistance. On the other hand, if you see the market going up into resistance and the order flow is slowing down and there isn't a lot of big orders coming in, probably not enough strength to make it go through resistance. So that's why we can't just use resistance alone. We combine it with momentum specifically, and it helps us to determine, okay, what are we going to do at that support resistance level? So, but yes, absolutely core, very important. Everybody should be using support resistance. They just need to add other things to it so that they can determine at each level, are we breaking through or are we bouncing off?
All right. Very, very good. Not a lot more comments. Burton wanted to confirm. He says, well, I took 2 years of physics in college, but he wanted to verify that he could take advantage of those trades on the same day. My recommendation to him, just by chat and answer, was that he'd be wanting to look at intraday charts. What is your feeling in terms of using like the top dog strategies on a same day basis, in and out on the same day?
Oh yeah, I use it for day trading all the time.
Okay.
I use it for both. I do day trading and I do swing trading. So just to clarify what I mean by that, when I mean day trading, I might take like 6 trades and be in and out on the same day, between the open and between the close. So yeah, I do that. But swing trading, I use daily charts and weekly charts for that. So, there's a few little different rules that apply, but the basic rules are the same. If you're swing trading, obviously you have overnight risk. So you have to add that to your consideration. If you're, well, that's one of the biggest ones really. And what I do with that is I hedge my positions with options to protect myself against that overnight risk. But intraday, yeah, absolutely. Works very well on intraday. Again, as long as you have a market, whether it's a stock or currency or whatever, future, that has enough volume. We want to have enough liquidity, and we want ones that are being traded by the professionals. So E-minis, S&P E-minis, for example, absolutely. Even the NASDAQ 100, yes. Whether you do it the ETFs or the futures, the stocks, Apple, plenty of volume. When you get down to stuff like pink sheets and penny stocks, not so much. I wouldn't personally do that.
What about out the money credit spreads?
At the money credit spreads, I actually personally prefer to go out of the money with credit spreads. But again, there's so many variables there. I mean, you can definitely use this for that. Now you're getting into a little different questions here.
We're getting into a paid class at this point, right?
Almost, yeah.
Sure.
You can use these strategies for it, certainly, because I do feel it's very important to be able to accurately read the chart of the underlying market of the derivative we call an option.
Yeah.
So that's very, very important. Now, yeah, that question is more of an option strategy question, which would be a different class. But I'll just say, when you're selling credit, we don't want to be assigned the stock. So the closer you get to expiration, the higher the opportunity for that happens. The more in the money you go, the more opportunity there's for that to happen. And those are just a couple of things there. Obviously, you're getting more premium when you go at the money, but you got to balance all these things against each other. And yeah, that would be another class.
All right. So Scott, off of UTIP says, good ideas and information, Dr. Barry Burns. So thank you for a good class. Silky Black, and I'm sure that's their real name, says, I'm glad I ran into this live. Very informative. So little bit of feedback. Not a ton of questions today, Barry, but great class. Appreciate it.
Well, thank you. My pleasure.
So I'm going to go ahead and take back over the slides. I do definitely want to spend a second talking about all the development work we did with kind of creating the Top Dog Toolkit. Obviously, our programmers worked very, very diligently, I guess is a good adjective to throw in there, to kind of create the 5 energy method as a MetaStock add-on. And if you're not familiar with MetaStock, that's okay. I'm going to tell you just a little bit about it. MetaStock's been rated #1 in this price category for 25 years in a row. I'm just going to kind of show you a little bit about how the Top Dog toolkit works inside of MetaStock. So I've got a chart loaded here. This is the Dow Industrial Average that I'm showing you here, and I've just applied the Barry Burns Top Dog toolkit to this, just to kind of show you how it works. And as Barry was saying, it's going to automatically identify the wave counts. It's automatically going to plot on the support and resistance. It's going to put a few of the moving averages. It's going to use his momentum indicators, and it's just going to kind of display everything for you. And all of this is pretty much automatic. You can see right here at the bottom, right now in the Dow Industrials, we're in an uptrend. We've been in an uptrend since right about here, and not right about, exactly October 10th. The market's kind of been taken off. There's a little bit of a pullback here. And you'll notice right now with his wave count, we've had our one wave, we've had our three waves. So we're 3 waves into this uptrend when we're looking at a daily chart. And again, this is all automatic. One of the things that you'll also notice is, I'm going to point it out right here. You've got an expert symbol. It's a buy symbol that appeared on the chart. And if I hover over it, it's going to say the first cycle low after DRAD turns up. There's another buy signal that happened a few days later that says first retrace in a long. And there's a handful of these signals that are available as part of the add-on. Again, when you apply the expert advisor, they're automatically going to show up. And I can even use the MetaStock software to explain those to me. So we have one of my favorite features here in the MetaStock software, which is what we call our commentary feature. I'm going to go ahead and kind of open that up on the side here. And I'm just going to highlight and have it tell me what it would have told me if I would have been looking at the Dow, which I was, on October 25th with this expert advisor. So right now the instrument is currently in a low cycle. You've got your first retrace in a long position. It gives you an entry position. You'll see that right here, 269.38. It gives you an initial stop position, so you know exactly where you're going to go. If this goes against you, where you're going to get out. And then it's going to tell you where you should put in your targets. So the first one would be a first cycle high. That would be right about here. The second cycle high, which coincides with the resistance level, or a trailing stop of your choice. And there was a lot of information that we took from Barry's courses that we wanted to have it available for you, but we didn't want it to be necessarily visible every time. So if you'll see here, for a full analysis of this signal, please click the link below. I'm going to go ahead and do that. And it's going to open up a web page for me. What you're going to see here is it's going to go through the setup, the confirmation, the entry, the stop, how everything's calculated, what you should do to increase the probability of success when you're in a trade. I'm not going to read this all out loud because that'd get rather boring, but and any additional commentary that you should be looking at. So that, in a nutshell, is kind of the way the charts are displayed. It throws all the indicators on there, does the cycle counts, and anytime that you have any of these buy signals, and you'll notice these last two were really, really good. It's going to give you exactly how to get into that, how to position your stops to get out in case that you're wrong, and et cetera, et cetera, et cetera. So in addition to that, one of the things I love about MetaStock is as an option trader, I know Burton was talking about option trades. As an option trader, I want to be able to go through and scan the market and find the stocks that actually have an opportunity today. Okay, and I'll show you a little bit about how that works. Right here, I'm going to kind of come in here, and I'm going to open up what we call the Power Console in MetaStock. If I go down to the scanner here, or we call it an Explorer in MetaStock, I'm going to point out that there's quite a number of these Top Dog scans that you can run. So, and I've actually added them to my favorites here. You can look for a DAD trade. You can look for that rubber band trade that Barry was talking a little bit about. You can look for trend trades. You can look for triangle trades. You can look for reversal trades in the 7 and 9. So you could actually, in fact, run all of them if you want to. And if I hover over any of these scans, it's going to be really, really specific about what it's looking for. So this one looks for DAD setups. These signals trigger on the DAD turning up after the first low of the new trend, or the DAD turning down after the first new bearish trend. Okay, and it's going to explain all of those to you. We have a manual that kind of walks you through all of this as well. I'm going to go ahead and have it run that scan. If I wanted to go in and literally have him run all 7 of those scans against like the S&P 500, I can just select the whole S&P 500 here. There's a list of the optionable securities that are available as well. So if you wanted to scan all of the optionables, you can do that. I'm going to go ahead and start the scan. It'll go ahead and kind of chunk through that data. You'll notice it'll run all of those scans. Don't think I'm going to necessarily let it complete, but you'll notice it's going pretty fast through those 500s. And right now it's looking for that rubber band trade. So if we did let it complete, what you're going to get is you're going to get a list of all the stocks that have an opportunity. So again, the idea here is to allow us to ignore the stocks that don't make sense and that don't have an opportunity. Let's step over those ones and let's focus on those stocks. There's more than enough opportunity with the 4,500 optionable strategies that exist in the market. Let's focus on the ones that have an opportunity that we want to see. So in a nutshell, that's kind of what we did for the Barry Burns add-on. It uses his 5 trend energy method: trend, momentum, cycles, support and resistance, and scale. And it combines that and it looks for patterns in the whether that's a new trend, a momentum. And I'm just going to start this from the slide. Okay, let's just go ahead and jump through this again real quick. Whether it's reversion to the mean, triangle patterns, it has all of those patterns that are built for you. It's been an extremely popular add-on, mostly due to the expertise and the work of Barry Burns. He's well respected in the market. $499, that's a one-time cost is what you pay for it. We're going to include here at the webinar that we're doing today a special $399. We do back that with our money back guarantee. So you can try it out. If you like it, great. If it helps you make money, great, keep it. If you don't like it, if you don't think it's helpful for you, basically you can just get a refund. Okay. If you don't have MetaStock, MetaStock's a software the engine that powers everything. We'll include a free trial of MetaStock with that, and you can also then find out why MetaStock's been rated #1 for 25 years in a row. So there's a couple of different ways to get some more information from us or to order. Go ahead and if you visit metastock.com/topdog, you can go in and that'll allow you to complete an order form for your risk-free purchase today. You can also give us a call, 800-882-3040, or you can chat online with us at metastock.com/saleschat. Okay. Ness just asked a question: is there a Top Dog scanner utility available? And I didn't see your question before I answered it, but I'm glad I answered it. So there you go. Barry, I do want to say real quickly, thank you for coming. I know you're busy. I appreciate your coming in and spending some time with us. For all of you that joined us through GoToWebinar or through YouTube, I want to say thank you for your time. I hope it was useful for you. Let us know if there's anything that we can do to help you. And I look forward to seeing you at the next one.